Today, we will start by delving into the world of business structures with a comparison of LLC and S corporations. What exactly are they and how do they differ? Let's break it down. To start off, let's talk about LLCs, which stand for limited liability companies. An LLC is a business structure that combines the flexibility of a partnership with the limited liability protection of a corporation. An LLC, or limited liability company, is a legal business structure that protects the owner's personal assets from the company's debts. You can think of an LLC as a hybrid between a partnership and a corporation. But unlike partnerships and corporations, LLC don't have their own IRS tax category. Instead, they're usually taxed in the same way as sole proprietorships or partnerships. However, an LLC can also elect to be taxed as an S corporation or a C corporation. Now, let's turn our attention to S corporations, often referred to as S-Corp. An S corporation is not a business entity, but a tax classification. Both LLC and corporations can be taxed as an S-Corp. An S-Corp doesn't pay corporate income tax, such as a traditional C-Corp does. Instead, company profits pass through to owners' personal tax returns. Not all businesses qualify to be taxed as S-Corp to elect S-Corp status. You must be a U.S. business. You cannot have more than 100 shareholders aka owners. Shareholders can be individuals and certain trusts and estates. Shareholders cannot be corporations, partnerships, or non-resident aliens. You can only have one class of stock. You can structure and operate your business as an LLC, but still be taxed as an S-Corp. There are several factor differences to keep in mind when you're thinking about setting up an LLC as an S-Corp. Taxes. By default, an LLC is taxed like a sole proprietorship or partnership. The owners are considered self-employed and must report business income and expenses on their personal tax returns. Each owner's share of the profits is subject to federal, state, and self-employment tax. However, the IRS scrutinizes S-Corp owners' salaries closely. In other words, it must be accurate and can't be unreasonably low. Not all LLC qualify to be taxed as an S-Corp. If your business does qualify, electing S-Corp taxation could limit who can own an interest in your LLC and how profits can be apportioned among owners. An LLC can have an unlimited number of members, while an S-Corp can have up to 100 shareholders aka owners. To elect S-Corp taxation, you must file Form 2553, Election by a Small Business Corporation, with the IRS. The form must be filed within 2 months and 15 days after the beginning of the tax year. An LLC owner might want to become an S-Corp for the tax advantages while avoiding dealing with the state law formalities of corporations, which would require having officers, directors, board meetings, and board minutes. It could be a good time to consider becoming an S-Corp when the company generates enough profit to make the change in tax structure worth it. An S-Corp also requires separate tax filings. Therefore, it may only be worth operating an LLC as an S-Corp when your company reaches a certain income threshold, and the additional costs and fees make sense from an accounting perspective. That's all for today's video. If you found this information helpful, be sure to give us a thumbs up and subscribe to our channel for more content like this. Thanks for watching.